Welcome back to Weekend Mac. We're going to continue to talk about monetary policy. So after discussing everything we have so far, it's finally time to talk about some of the pitfalls of these policies. Okay, so of course there is good impact, and we've seen that it has positive outcomes in the economy in terms of how monetary policy impact interest rates and how that translates in terms of changes in output and the price level. But there are some limitations of this type of policy. The first one, which you've probably noticed that I mentioned throughout the video, it takes time for these changes to happen. Right? Given there is a change in the money supply, that would then depend on the adjustment of the loanable funds market to change interest rates and loans, which then depends on how much time it takes for banks to make those loans and make those decisions in terms of who are getting the loans, and also the people to go request for those loans, right? So it takes between 1 and 3 years to be able to have that impact. So the fact that it takes time may be that by the time that the stimulus finally kicks in, the economy is already a different economy. Maybe the recession is worse. Maybe the recession is better. Right? So it's really hard to implement a policy where it's just going to have an impact a year later or more. And as we know, it's really hard to predict what's going on and what will happen in the economy. Right? The second type is going to come from this quantity theory of money. So this is the idea that we can predict production in the US, the price level, output, given that we know the money supply, and we can make make an assumption about how people spend money. Okay, so this idea is going to be M is going to be the money supply. Okay, V is going to be a variable that we'll define as how quickly money circulates, so how many times a dollar exchange hands in an economy. Okay, so the amount of money in the economy times, you can think about it times of something like the money multiplier, right? The amount of times that people spend that money will equal the total total production for the economy times the price level, right? So the total revenue raised based on all the products that were sold. Okay. Of course, you can see here P times Y is nominal GDP. Okay, so the velocity, how many times money exchange hands times the money supply equals nominal GDP. Okay, so what's the problem with this? That it sounds like completely feasible. Well, it sounds feasible if we can predict what V is, right? The central bank has definitely an idea what M is, but can it predict what V is? If so, then it can properly change the money supply to have a proper impact on economic activity. Okay, so here's a question that can help us get to this idea and whether or not you're understanding it. If velocity is constant over time, then the positive change in the money supply will lead to, so let's look into that quantity theory of money, N times V equals P times Y, okay? If velocity is constant, that means this is not gonna change, right? And that means the only three variables that will change are money, price, and Y, okay? So if velocity is constant, a positive change in the money supply, an increase in the money supply will lead to a positive change with the same proportion of nominal GDP. So as you can see, this is nominal GDP, right? This is nominal GDP. So we're trying to see, given the velocity is constant, if there's an increase in M in the money supply, what would happen to the entire right-hand side of that equation, okay? Would it increase by the same proportion? Would it decrease by the same proportion? Would it cause no change at all, or we're not even have enough information to do that, right? So hopefully from our classes, we know that, hey, we know we're focusing on just this combined side on the right-hand side. So one variable total, the nominal GDP, right? We have one variable constant, we know what's happened to the other variable. Right? Given that V is constant, an increase in M will cause the same proportional increase in nominal GDP. Okay, so it causes a positive change of the same proportion, right? So this is the hard part here, is that to do so, we need to be able to properly predict the velocity for an economy, okay? And for a long time, this was possible, right? So, but eventually, this assumption broke down. That's one of the reasons why it's so hard to predict the outcomes of monetary policy today. Okay, and you see that in this graph right now. Okay, so in the 60s and 70s, you can see that's somewhat predictable. You could see that certain increase, but it was somewhat predictable. But then after it hit the 80s, you can see from here to here, we kind of don't know how to predict, right? All this area here, this entire range, is a lot more unpredictable than this upward trend that we saw before. Okay, so because now we can't really predict what's happening with velocity, it's really hard to predict the correct money supply change that we need to then cause changes in economic activity. Also, we need to think about, given that we're doing that, what is actually increasing on the other side? Is the price level increasing on the nominal GDP, or is GDP increasing? Because remember, MV equals PY, right? So if V is constant and M increases, this is going to increase, but which one is it increasing? Is price changing more than output, or is output changing? Remember, we want output growth, but we want to control for inflation. So you can see the challenges of monetary policy, right? So here's some more discussions about some of the challenges they meet. The first one is that, hey, if we're just providing loans for the demand to increase, but the long run efficiency, the long run production of the economy is not changing, then what's the point, right? If we're close to our potential GDP line, then that means that if we're not changing the potential GDP line, then we're going to stay around this line, right? This production of this total GDP, real GDP production, right? If that's the case, increasing production by stimulating the economy through expansionary monetary policy, all it's doing is that eventually we're just going to increase the price level, or we're going to keep bouncing back around that same level of Y. So we have to be very careful. We don't want to expand the economy too much past the potential GDP line, where we're going to be around the GDP line, but only inflation will keep popping up, right? So the idea behind monetary policy is to be able to make those loans more available, but they're properly done in a way that, because we're searching for the most efficient borrowers, their investments are going to pay off, and eventually that can lead to increase in the long run GDP, right? So if those loans ended up leading to more technological advancements, for example, eventually the hope is that that line can start shifting to the right, and as you can see, that would lead us to higher levels of output while getting a lower inflation. Okay, so you can see here how we have to balance this out, the idea of increasing output with increasing the price level. And as you can see so far, we've really highlighted the importance of controlling for inflation. It's been the priority. I showed that on the episode 1 when we talk about the retrospective of the Fed. And this has really been the goal of most of central banks around the world. Okay, a lot of them also focus once again most of them just focus on inflation, but the U.S. also focus on unemployment. Okay, but despite having both goals, as you've seen, they do focus more on inflation. So that's the main point of this slide. Okay, the last part I want to point out is that should monetary policy be democratic, right? That's not something I brought up so far, is that we're voting for the president and Congress and Senate, right? But we're not voting for the Federal Reserve chairman and the board of governors. Should we vote for them? What are some of the pros and cons of this decision of making maybe the central bank a democratic election? So let me know what you think, and we're going to talk about that in the virtual class.